Hey, welcome back to the channel. You're watching The Compounding Effect. In this video, I'm going to show you how to pick a basic, sensible ETF as a European investor using JustETF, step by step, in a way that's simple, repeatable, and honestly, a lot less overwhelming than most people make it. Because right now, if you open JustETF, you'll see something like hundreds of ETFs staring back at you. And that's usually where people either freeze, or they pick something random, based on a name that sounds good, a recent performance chart, or a YouTube comment. So today we're going to fix that. By the end of this video, you'll know exactly how to narrow hundreds of ETFs down to a small shortlist, using a handful of filters that actually matter for long-term investors in Europe. Quick disclaimer before we start. This is educational only, not financial advice. Always do your own research. Alright, first things first. An ETF is a basket, a package, a single product that holds many investments inside it. So instead of buying one company, like one stock, you buy one ETF, and that one purchase can give you exposure to hundreds or even thousands of companies. It can represent an entire country, an entire region, or even the global stock market. And that brings us to the core point of an ETF, the reason ETFs are so popular among long-term investors: diversification. Diversification is not a fancy word. It's simply the idea that you don't need to bet your future on one company, one sector, or one country. You spread your risk across many businesses and let the overall economy do the work. And there's a famous quote often attributed to the well-known investor Harry Markowitz that says, "Diversification is the only free lunch in investing." And whether the quote is attributed perfectly or not, the principle is absolutely correct. In investing, almost everything has a trade-off. Higher returns usually come with higher risk. More control usually comes with more complexity. More potential upside usually comes with a higher chance of messing things up. But diversification is different. Diversification reduces risk without requiring you to be smarter, faster, or more experienced. It's one of the few things that makes your portfolio more robust without demanding extra skill. So when you invest in a broad ETF, you're not trying to be a genius. You're choosing a structure that makes it harder for one mistake to ruin your long-term outcome. Now, why use JustETF specifically? So JustETF is not just a nice website. It's an incredibly practical tool for European investors to compare funds, understand what they hold, and filter out the noise. Now let's talk about the problem. There are hundreds of ETFs. How do you choose? Here's the mindset I want you to adopt. You are not trying to find the perfect ETF. You are trying to find a good, boring, reliable ETF that fits your situation, and then you want to stick with it long enough for compounding to matter. That's the game. So now let's go through the filters you asked for, one by one, in detail, the way I'd explain it to someone who is just getting started. We'll start with asset classes. This is the most basic decision. What kind of investments do you want this ETF to hold? On JustETF, you'll see categories like equities, bonds, precious metals, commodities, cryptocurrencies, real estate, and money market funds. If you are investing for long-term growth, especially if you're younger or you have a long time horizon, most people start with equity ETFs, meaning stock ETFs. Not because they are always comfortable, but because they have historically delivered the strongest long-term returns. Bonds can be useful, but bonds are usually about stability and lower volatility, not maximum growth. They often make more sense when your goal is capital preservation or when you're nearing the point where you want to use the money. So the asset classes filter is basically, what is your goal? Growth or stability? For most beginners building wealth over decades, the typical starting point is a broad equity ETF. Now that we've selected equities as our asset class, JustETF opens up a few more filters that sound tempting, but this is where a lot of beginners accidentally make things more complicated than they need to be. You'll see options like region, country, sector, equity strategy, and theme. Let's start with region. If your goal is long-term wealth building and broad diversification, the simplest and most robust choice here is world. A world equity ETF spreads your money across thousands of companies in dozens of countries. You're not betting on one economy to outperform. You're owning a slice of global capitalism itself. Then there's sector. Technology, healthcare, energy. These can all be exciting, but choosing a sector ETF is, by definition, a bet that one part of the economy will outperform the rest. That reduces diversification. For a basic, sensible ETF, It's usually better to select no sector and let the market decide which industries win over time. The same logic applies to themes. Clean energy, AI, robotics, emerging trends, these often sound compelling, but they are usually narrow and heavily hyped. Themes reduce diversification and can underperform for long stretches. So here as well, we leave the theme filter empty. Finally, there's equity strategy. Things like value, growth, quality, or momentum are legitimate approaches, and we'll cover them properly in a separate video. For now, you don't need to choose one. Different strategies all aim to perform well over the long term, just in different ways, and skipping this filter keeps the process simple. And here's the important part. With just these few choices, world exposure, no country, no sector, no theme, and no strategy, we've already narrowed hundreds of ETFs down to roughly 30. In just a couple of clicks, the universe goes from overwhelming to manageable. Next filter, age. This means how long the ETF has existed. Why does that matter? Because an ETF is a product. It has a structure. It has a provider. It has real-world tracking behavior. A fund that has existed for many years has a proven operational history. It has lived through different market environments. It has shown that it can track its index properly, handle inflows and outflows, and function during stress. A very new ETF can still be fine. But with new ETFs, there are two risks. First, limited track record. Second, a higher chance the fund closes if it doesn't attract enough assets. So for a basic ETF, especially for beginners, I generally prefer ETFs that have been around long enough to show stability. You don't need a fund that's 50 years old, but you do want something established. Now, use of profit. This is one of the most important choices for European investors. Here you'll see two main options: accumulating and distributing. Distributing means dividends are paid out to you, usually quarterly or semi-annually. Accumulating means dividends are automatically reinvested inside the fund. You don't receive cash in your account. Instead, your ETF price reflects the reinvestment over time. So which one is better? Here's the key. It depends on your tax system, but in many European countries, accumulating ETFs are often more efficient for long-term investors. Why? Because distributing can force taxable events, reduce compounding, and create friction, especially if you're reinvesting anyway. Accumulating is basically the quiet compounding option. It's the choice of people who want the math to work as efficiently as possible in the background. Distributing can make sense if you actually need the income, for example if you're already retired and living off the portfolio. But if you're still in the building phase, accumulating is often the default choice for European investors. Next filter, fund size. This is about how much money is in the ETF, assets under management. Why does fund size matter? Because size often correlates with stability, liquidity, and operational efficiency. A larger fund typically means it's widely used. That tends to mean tighter bid-ask spreads and better trading liquidity. It also generally lowers the risk that the provider shuts the ETF down. If an ETF is tiny, there is a non-zero risk it gets closed or merged. That's not the end of the world, but it can create inconvenience, taxable events, or forced changes. So I generally avoid extremely small ETFs unless there's a very good reason. For broad, basic ETFs, there are almost always plenty of large, established options. Now we come to an important filter, replication method. On JustETF, you'll typically see full replication, sampling, and in some cases swap-based. Full replication means the ETF holds all the securities in the index. If it tracks an index of 500 stocks, it owns all 500. Sampling means the ETF holds a representative subset, designed to track the index closely. Sampling is common for very large indices or indices that are harder to replicate fully. And sampling is not a red flag. It's a practical method. For most investors, full replication and sampling are both absolutely fine. The difference usually matters less than people think, especially for broad equity ETFs. Now swap-based ETFs. Swap-based means the ETF uses a derivative contract, called a swap, to replicate the index performance, instead of holding the underlying securities directly in the same way. These ETFs are regulated in Europe and they can work well. But for beginners, I generally recommend staying away from swap-based ETFs unless you truly understand what you're buying. Next filter, fund domicile. This is where the ETF is legally based. For Europeans, the most common domiciles are Ireland and Luxembourg. Why does that matter? Because domicile can affect things like withholding tax treatment, treaty benefits, and regulatory structure. The impact depends heavily on your personal country and the ETF's underlying holdings, but domicile is not just a random detail. For example, many large global ETFs are Ireland domiciled because of how tax treaties interact with US dividends inside the fund. Luxembourg is also common. Neither is automatically better in all cases, but it's worth paying attention to because it can influence net returns through tax drag. And here's an important point: your personal tax system still matters. JustETF helps you select ETFs, but you should always cross-check the tax implications for your country, especially when choosing accumulating versus distributing, and when thinking about where the fund is domiciled. Now, how do we use all these filters together to find the best ETF for you? Here's the practical process. First, you decide what kind of ETF you want at the highest level. For most people starting out, that's a broad equity ETF, so you choose equities as the asset class. Then you apply the filters world, no sector and no theme to remove complexity and improve quality. You choose a fund age that gives you a track record. Depending on your tax situation, you choose accumulating if you're still building wealth and your tax system rewards that structure. You choose a fund size that is large enough to be stable and liquid. You choose a replication method that is full replication or sampling, because for a basic ETF, that's usually the simplest, most transparent route. And you prefer domiciles like Ireland or Luxembourg, then double-check which makes sense for your specific situation. Once you do that, you'll notice something. Those hundreds of ETFs shrink quickly. You go from chaos to clarity. The number shrinks down even more if you only invest in accumulating ETFs. And that is the real skill. Not picking the best, but building a repeatable system that gives you a good shortlist, consistently. Because in investing, consistency beats cleverness. And that brings us to the conclusion. If you take one thing from this video, let it be this. The best ETF is not the one with the most exciting story or the best recent performance. The best ETF is the one that matches your long-term plan, keeps costs low, stays diversified, and makes it easy for you to keep investing month after month. If you found this video helpful, make sure to like, subscribe, and share it with someone who's just getting started. Thanks for watching, and I'll see you in the next one.